Hey traders and investors, it is Wednesday, April 30th. Markets are selling off pretty good. We're going to jump into the charts, mostly the large, well, we're seeing both large caps now and small caps starting to drop. So before we just had the big, large techs dropping. Now we actually have people running away from small caps. So it's very interesting. Going to be a volatile session. Volatility index most likely spike up. Probably going to see panic selling. I also talk about price gaps and how to go about kind of trading them in a way and how to view them later on in the video. But just a quick reminder that, we are coming into a very crazy market condition that this could take years to unfold, and more or less most investors and traders are going to end up blowing up their retirement account. I have been there. I have done that in a stage 4 decline. It blows up your retirement dreams, changes your lifestyle if you don't protect yourself from the downside. So this covers pretty much everybody, unfortunately, but if you hold individual stocks, commodities, or crypto, if you hold dividend stocks, believing that reinvesting in dividends and getting their little yields is going to save you, it's not. More or less, if you trade around news or believe in economic data and fundamental data, that is not going to save you. That stuff is actually going to be getting worse. And if you use covered calls and on your long strategies to try and hedge your positions because you like them, or if you just hedge your portfolio in any way, you're going to really suffer, because the buy and hold strategy and trying to hedge is just a volatile, expensive way to try to preserve capital. And again, if you've got a financial advisor, they don't really manage money. Well, actually they do. All they do is manage money, but they don't manage risk. And you're going to be left holding the bag, losing a lot going forward. So there is a lot of stuff unfolding. Things are going to get ugly. This is just the beginning. The market's just had its first downward move, and we could still have a little bit of an upside potential here before we start to go into a big sell-off. But this could take years to recover from, and it's all about protecting capital. It's much better to miss out on a little bit of gain in case the market does go higher than it is to wipe out 5, 10, 20 years of your lifestyle or savings just because you don't want to get out of a position. So be very aware of that. The charts. We got a bunch of earnings coming out today, a big blizzard of them, more or less. So we've got Microsoft and Meta are going to be the spotlight as the big techs. Let's just take a look at them. We've got Meta here, which is, you can see it's starting to pick up speed to the downside this morning, down about $12 per share. If we take a look over at Microsoft, it is down quite a bit as well, selling off, and that's dragging the markets down. We got the NASDAQ down 1.1%. The other indices are all down about 0.7%. But there's a lot in the news today. We have 50 stocks from the SP 500 all reporting earnings. So that's 10% of the index moving down here. So, or not moving down, but reporting earnings. So expect a lot of noise and turmoil after the close and throughout the day as things kind of unfold. Now, overall, the market is trying to figure out some traction. If we take a look at our overall strategy charts here, you can see on the right-hand side our sentiment chart. We're starting to get a little bit of bullishness, short-term bullishness, to see if this market wants to kick into expand and start to move higher. Now, it's hard to see these lines, but overall there is potential this market wants to move higher. If I just grab the Fibonacci extension, we do have pretty extreme big volatility levels through here. It is pointing to the market wanting to push up to these highs and potentially want to run past those and get the shorts out. So the market is trying to firm up and get up to this level. And of course, this is going to act as a key resistance area, not only Fibonacci, but a pivot high, and that will be where a lot of people will have their shorts. Just like if the market had in a pivot low, people would say, well, if it drops below here, I'm going to get out, and that's what it does. It runs those lows and then can continue to even go even lower. And on the verse, when we're in a downtrend and we have these highs, we can see the market want to push up and make everyone want to cover these shorts and get out. So it'll be very interesting to see how this market unfolds. It is on the cusp of a half decent rally to the upside, or it is going to go back down and test these lows or go even lower and continue to grind. And I showed this a couple days ago in the video, what happened back in 2007 and how the dollar and how gold were moving and how we go into a a kind of a big bear market rally. It could have massive volatility, but overall it kind of works its way into a sideways move here and then goes for that next big move. The question is, does it put in another low, or is it going to work itself up into this range and put in a bear market rally or a dead cat bounce? At this point, we're just in this volatility phase where it kind of straight down, straight back up, and it's really just in noise, but it's starting to firm up based on our analysis short-term wise. If we take a look at what else is moving today, we did actually see utilities move up fairly strong yesterday. They're holding up fairly nicely. They actually look like they're poised to want to continue to move higher as a defensive play. Usually if utilities are doing well, that usually means the stock market is struggling and getting closer to a pullback. So we'll see how we'll keep our eyes on utilities and how that moves. If we take a look at consumer staples, XLP, again, another defensive play. No matter what happens, we still need toothpaste, toilet paper, all of the basic staple products. So it is holding up. It has been choppy, but going sideways for many months. And that is because it is a defensive, boring sector. But that's where people put their money when they don't know what else to do. They just get out of speculative plays and move into the boring things. And that's also similar to gold. We do have gold down this morning, down over 1% this morning. It is in this little bearish formation that we've talked about. We've got this hit that 3,500 upside target that we had, and you can see how it has moved based on Fibonacci extension. We can get that to lock here. There we go. Down to 31.45 is the next kind of potential downward move. So based on yesterday's close, it has potential to drop about 5+%. And from where it is right now today, that is, whoops, wrong tool. Okay, hold on. It's about a 4.5% drop from where it is this morning. So we'll see if that little pattern unfolds and then how it's going to consolidate through here. Now, this is a 100% measured move based on a couple different levels, this tiny one and a larger one that comes back into this breakout level here where we measure this pullback. So this is a fairly significant level, just like we hit over here with our 1800 target. Hold on. Sorry, our 2800 target. We had this consolidation. It pulled back right through here. Whoops. It pulled back through here and took a consolidation. So gold could simply have another one of these consolidations. Overall, again, the video from 2 days ago, the first 5 minutes, I show the comparison of where I think the gold price, the stock market, the SP 500, and the dollar are within the major cycles. And I do feel like we are in that nosebleed territory for gold. I think the dollar is overdone and down near rock bottom for this overall cycle, and how the equities markets have already rolled over. So I'm pretty nervous about this particular setup that we have right now in terms of gold. Again, it is still in a strong uptrend. You do not want to bet against it. I mean, you don't want to bet against it falling. But overall, we'll have to see how it goes. But it has that parabolic move that signifies it may have one more little push up. We'll just have to see where this correction plays out, and then we can gauge where that next move up. But overall, it looks like it is getting pretty ready to put in a major top and sell off with the stock market. But we could see gold hold up or move higher still for another month or two based on a bear market, a dead cat bounce. We could see that happen. So let's take a look at oil. Oil down 1.25% this morning. More or less, you can see here, it's really picked up speed in the last couple of days. It broke down below this significant $65 per barrel level, and it kind of had a little bounce, came up into resistance. It's rolling over and selling off. That's telling us that to me, oil is kind of overall, the recession is like kicking in. Things are slowing. Transportation slowing. We're already seeing all kinds of stuff with the airlines slowing down. And even prices at airlines have dropped dramatically. I just booked some flights. They're about $700 less than they were about 4 months ago for the same flights. So everything is really starting to drop, and they're starting to see shipping. China manufacturing is down dramatically. People are just putting a halt on stuff. With all these tariffs, factories and companies are just saying, well, let's not do anything. I don't know where the tariffs are going to be. I don't know if they're going to come into effect in a couple months or not, or what level. So oil has been telling us this, and this is something I've shared many times, that when oil breaks down, and that's going to be the sign that, okay, I think a recession is coming, and then we're going to see the news come afterwards. And that's what we're seeing now is manufacturing numbers are dropping, sales are slumping, all of that stuff. Recession is kind of kicking in, and oil is that leading indicator. A lot of people tend to use copper for this, and copper has been a good barometer of the market. But overall, it has been noisy, and I don't really see it acting as that play so much. It does definitely have one of these huge spike highs. It recently had one several months ago. Overall, it is kind of up in nosebleed territory in terms of, if copper is up here, it's probably near a significant top, and the economy probably doesn't have a lot more to go. And of course, we've seen it really unwind in the last, just this session. It's really starting to come down. But I don't look at copper anymore too much as a broad economic indicator. Another one people like to look at, or I used to too, is the transportation index. IYT is ETF to follow it. It's still holding up fairly strong. It's been trading sideways for quite a while in this big volatile range. It has had a pullback, and typically you'd look at the Dow, you'd look at the transportation index to lead the market, and the transportation index was one that I looked at. I used to follow a lot. But the thing is, the world has really changed. Everything now is shipped, and a lot of companies are shipped, direct to consumer. So it doesn't matter, even if we're in kind of a recession, things are starting to slow. More and more products are being shipped from each company direct to the user, keeping the transportation index really holding up with good profits and holding up. So again, you can't really use the transportation index at this point anymore. At one point, we're going to see this drop. Probably look at the Baltic Dry Index, which I don't have here, but if we look at sea containers, it's probably dropped fairly dramatically, which would be more of an indicator of global economic weakness versus the transportation index kind of basket here on its own. So last but not least, I was talking to a subscriber last night about price gaps. He wanted to know about price gaps, so I want to just touch on this fairly quickly. There's a lot going on with price gaps in the market. I'll just go full screen here. And gaps, as we know, tend to get filled. So in the SP 500 is the key thing. So like right here, we've got this massive gap window. This is a huge 3.5% drop in the price. This is in the SP 500. One night we had a drop of that. That is a massive drop. Typically a gap, which I usually color in blue, I call it a gap window, usually less than 0.5%, maybe 1%, but a 3.5% move is pretty darn big. We've had a couple of those. In fact, we've had another one here that was 2.5%. We had another one over here that was pretty massive, 3.5%. These are huge. These are like 10x of what normal price gaps are. And gaps tend to get filled. This one here, we had another one right down here, which is another big one, another 3% gap. That is some pretty big volatility. All of these gap windows tend to get filled over time. And if we go back all the way to where we are now, actually, let me just draw in a couple here. The market is very efficient. It doesn't like gaps. Typically, there's going to be all kinds of orders sitting in here, limit orders of all sorts sitting in each of these big gaps. And the market is very efficient. It wants to run through all those more orders and trigger them. And so the market usually backpedals or whatever it has to do to try and get back to those levels before it really continues on. And so if we take a look recently, we've had a couple pretty big gaps here. They have not filled yet to the upside. And the market is most likely going to want to fill them. There's obviously other ones. This one here was filled within the same day. This one here was recently filled with the price coming up over here. But we have a gap window down here. We have a gap window down here. And the crazy part is we still have a gap window over here. we still have a gap to the upside. So this market's most likely going to want to try and run up and push these levels and break this high. This is what I was talking about on the SP 500. This is a significant high. The market's probably going to want to run up and blast through that. It'll probably create a lot of short covering because this is a significant high on the daily chart, and a lot of people who are short the market expecting it to continue to go lower will have their shorts set that if this high is broken, they're going to cover, and they're going to buy back shares to cover that position, potentially even get long and create, even more buying pressure to create that surge to the upside. So the market loves to fill these gaps, and we tend to watch these. Now, here's the thing. When we get into a super volatile market condition like this, where everything is flipping and flopping between a downtrend to neutral to downtrend to neutral to green, which is an uptrend, short-term uptrend, and we've got these massive waves of panic selling and FOMO and panic and FOMO and panic and FOMO back and forth, gaps become a little more difficult to trade. They might not get filled for several weeks or days. Usually a gap gets filled the same day, usually before lunch or by the end of the day. So when we get this massive volatility, gaps can take a long time to get filled. They can take several days. They carry a lot more risk. But the key here is just to know that gaps tend to get filled, and there is a big gap on this chart way up here that still needs to get filled on the SP 500. It's probably same for the QQQ. If we take a look, we're probably going to see very similar type of price action. The QQQ's actually already filled this gap, it looks like. So this was that gap. So it has filled that price gap already, and which is interesting. We'll see. I guess there's another high back over here. But anyways, it is definitely up into a resistance zone, on this chart. And it's filled that gap. The SP 500 is the key one that I look at. To me, that is the broad market. If you know what the SP 500 is doing, you know what the rest of the indices are going to do on average. And so that's the core focus there. So hopefully that kind of answers a couple questions around price gaps. Oh, I think the key thing I was just mentioning here, when we have this massive volatility of panic and FOMO and panic selling and FOMO back and forth, I don't really talk much about gap windows. You'll notice I haven't talked about these. I say there's going to be huge gaps, and you're going to be having waves of FOMO and waves of panic, and that's normal. That's okay. That's what happens in this scenario. But when we're back in a more lower volatility market condition, and we have these gaps where it gaps up, flushes everyone out, and then fills the gap, and then it gaps down and comes up and fills these gaps. We have all of these little gaps that get filled. I do talk about them more, and I share them as, hey, this is an opportunity. We should see these gaps get filled through here, simply because a lower volatility market, they tend to fill quickly, and they're fairly straightforward. But when we get into complete chaos like this, I don't really want to mention too much about gap fills, because the gaps don't have a high probability of filling quickly, and the gaps are huge, and volatility is massive. You've got like 10x risk, and you got to, not only volatility wise, is it 10x the size of normal gaps, but you also have to probably put in 10 times more time for those gap windows to fill. So you could potentially take a bigger hit, and you got to wait like 10 days for something to fill if you can hold out on it and go through the roller coaster ride of all of that. Just a quick reminder, if you want to attack these markets from a different perspective, because really we only all have one shot at retirement. If we blow it and don't have the money to live what we want and do what we want, it is not where we want to be. So we only have one shot at it. What I teach here and what I'm sharing you is stuff from our asset revesting book. This is all about making sure we don't hold things falling, that we're only holding exclusively assets rising in value. And again, if you like the technical analysis side of things, technical trading mastery, this is also where I show the 30-minute chart strategy, trading overbought, the panic selling, the FOMO indicator. I show you how to set that up, how to identify overbought, oversold conditions in the markets, and a lot of other stuff around technical analysis. This is just the core stuff. If you can understand what I teach in this book and have the proper expectations from the markets and know how to read the charts, the things that matter to me the most that I share with you, it's all in this book. And on top of that, if you're interested in learning more, Trading Strategy Mastery, this is a 3-hour course, a video course that more or less, if you have strategies that you already kind of do, you have in your head, this will help you document them. And during the documentation phase, you learn that probably all of your strategies don't actually work that well in in the long run, because market conditions change, and it allows you to figure out how to make your strategy actually profitable and when not to trade it and when to trade it. There's certain market conditions where your strategy idea should, while it works in some conditions, it doesn't work in others. So this is a great way to modify and add some more trades to your strategies, knowing which ones to trade at certain times. And then, of course, trading is your business course. This is treating trading like a business, not a casino, not out to get you excited and to have a rush, but to actually grow your wealth, protect it. And it requires self-discipline. That is the markets. If you don't treat the markets like a business, you eventually just end up rotating your capital, just churning it. You have good years and bad years, and you never really, have that consistent growth in your account. So you can always go to our website, go to books and courses, and you can get access to all of these. The books are on Amazon. The courses are through our website. Anyways, I think that's it for this morning. Not a whole lot has changed. The markets are close, trying to get traction into to pop and start to expand to the upside in the equities market, to maybe move higher and have a more of this dead cat bounce that I've been talking about, where we could see something similar to this. We're coming up. Oops, right here. Let me just grab a box. So we're kind of, I believe, something similar to there, where this market could extend and put in a sharper shoulder, and this would suck a lot of people into the market. This would create this shoulder, head, shoulder, and then from there, if the market was to roll over, we could go a lot lower and break this neckline. The Nasdaq has a sloping down neckline, which I'm not a big fan of. If we go to the SP 500, the S&P 500, it also has a sloping neckline, which means volatility is increasing, and it could become a whole lot more volatile to the downside. I like it when the neckline is sideways, like just horizontal, or actually sloping up. When it's sloping down, it just means there's some pretty severe volatility and panic. And you can see that in this market with the volume here. Anyway, that's it for now, and we'll talk to you soon. Bye-bye.